The day that auto workers in Oshawa, Ontario have dreaded for months is nearly here. General Motors is cutting a shift at the city's plant as the company continues to scale back its Canadian operations.
One decision, one factory, and one policy choice have just put more than 7,500 Canadian jobs at risk, pushed vehicle prices in the United States higher by an estimated $7,400 per unit, and exposed a North American auto system that may be far more fragile than Washington admits. General Motors' move to eliminate the third shift at its Oshawa assembly plant in Ontario is being presented as a routine adjustment. It is not. Up to 1,200 workers face direct layoffs, and internal supplier data suggests that for every assembly job lost, at least 6 additional positions across parts, manufacturing, logistics, maintenance, and regional services immediately fall into danger. This is not a localized labor dispute. It is a system-level shock triggered, but the Oshawa layoffs are not the real story. They are the warning signal. Because behind this decision lies a much larger and far more uncomfortable reality, one that suggests the tariff strategy meant to protect American industry may instead be accelerating job losses, financial stress, and demand destruction inside the United States itself. Listen to the end, because today I will reveal a counterattack Canada is preparing that carries damage estimates so severe they have never been publicly disclosed, and that could abruptly shift economic power away from Washington in ways few policymakers appear ready to confront. What happened in Oshawa is not an isolated production cut. It is the first visible fracture in a continental auto system that moves more than $2.1 trillion in vehicles, parts, financing, and downstream services every single year across North America. Under the current tariff structure, vehicles assembled in Canada and sold into the United States face a 25% import tax. On paper, that sounds targeted. In reality, it detonates a cost cascade that spreads far beyond the factory floor. Open supply chain data show that nearly 2/3 of components used in vehicles assembled in the United States originate outside American borders, with Canada as the single largest source of engines, transmissions, aluminum castings, and advanced electronics. When tariffs hit finished vehicles, suppliers do not absorb the cost. They pass it upstream and downstream simultaneously. Industry modeling indicates that every $1 added at the border inflates total system costs by more than $3 once logistics, inventory delays, compliance overhead, and financing friction are included. Applied across annual vehicle volumes, that multiplier translates into tens of billions in added cost pressure inside United States plants alone. The numbers escalate quickly. Within 12 months of the tariff expansion, estimated production costs at major United States auto plants rose by nearly 19%, the fastest increase since the oil shocks of the 1970s. Despite record sticker prices, profit margins collapsed. Analysts tracking balance sheets across the Big Three estimate that more than $45 billion in operating margin vanished in a single year. That capital did not return to workers. It did not return to investment. It was consumed by friction. Consumers felt the shock immediately. Average transaction prices for new vehicles surged, with some full-size pickup models increasing by more than $7,000 compared to pre-tariff levels. Demand responded exactly as economic theory predicts. New vehicle sales in the United States dropped by roughly 14% year over year, erasing nearly 2 million unit sales. That demand destruction alone wiped out revenue equivalent to the annual output of several major assembly plants. And this is where the feedback loop turns dangerous. Canada is not a peripheral market. It is the largest foreign buyer of United States-made vehicles by value. In recent years, Canadian consumers purchased more than $15 billion worth of American-built cars and trucks annually, more than the combined total exported to China, Germany, Japan, and the United Kingdom. That demand functions as a stabilizer for United States production lines. Remove even a portion of it, and the system destabilizes fast. Conservative scenario modeling shows that a 1/3 reduction in Canadian purchases of United States-built vehicles would remove more than $5 billion in annual demand, almost immediately. A deeper consumer pullback pushes that figure beyond $12 billion and places hundreds of thousands of American jobs at risk across assembly plants, dealerships, logistics networks, and regional suppliers within 18 months. These are not distant hypotheticals. Early indicators already show Canadian consumers quietly shifting purchases away from United States brands as prices rise and trade tensions harden. Each decision may appear small. In aggregate, they become seismic. And yet, this still only captures the industrial layer of the shock, because buried beneath the factory data is a second wave of exposure that rarely makes headlines, one tied to debt, credit markets, and state finances. Internal risk assessments suggest that the next stage of this tariff-driven chain reaction does not begin on an assembly line, but inside balance sheets, pension funds, and municipal budgets. That is the part almost nobody is talking about. And in the next section, I will explain why this hidden financial pressure may prove far more damaging than any factory shutdown, and why Canada's response is quietly targeting this exact vulnerability. What most people miss about the Oshawa layoffs is that the auto industry does not end at factories or dealerships. It sits at the core of the American financial system. When tariffs distort vehicle production and pricing, the damage does not stay in manufacturing. It spreads directly into credit markets, pensions, state budgets, and household balance sheets. The scale of exposure is staggering. United States automakers and their captive finance arms collectively carry more than $1.3 trillion in outstanding corporate and consumer-linked debt. Those obligations are structured around assumptions that vehicle sales volumes remain stable and that depreciation follows predictable patterns. Tariffs shattered both assumptions at the same time. As vehicle prices surged under tariff pressure, affordability collapsed, loan terms stretched longer, down payments shrank, delinquency rates began to climb. Open consumer credit data show that subprime auto loan default rates moved above 9%, the highest level ever recorded. More alarming still, delinquencies among prime borrowers nearly doubled within a single year. That is not consumer irresponsibility. That is price shock. Vehicles are no longer reliable collateral. When repossessed vehicles sell for less than the remaining loan balance, lenders absorb the loss. Multiply that across millions of loans, and the stress migrates rapidly into regional banks, pension funds, and asset-backed securities markets. Internal stress testing conducted by financial institutions shows that even a sustained 10% decline in vehicle sales places multiple auto finance divisions into technical insolvency within 2 years. Current sales declines already exceed that threshold. This is where the spiral accelerates. As credit tightens, dealerships lose floor plan financing. Suppliers lose access to working capital. Smaller manufacturers fail first. Layoffs spread outward from assembly plants into transportation, warehousing, advertising, construction, and retail. Entire regional economies feel the contraction. State governments are next. Auto-heavy states depend disproportionately on payroll taxes, sales taxes, fuel taxes, and property taxes linked directly to vehicle production and consumption. Internal fiscal projections indicate that Michigan, Ohio, Indiana, Kentucky, and Tennessee collectively face revenue shortfalls ranging from $48 billion to more than $60 billion over the next 3 fiscal years if current trends persist. States cannot print money. They cut spending. Public sector layoffs follow. Infrastructure projects are delayed or canceled. Pension contributions are deferred. Credit rating outlooks are quietly revised downward. Borrowing costs rise. The damage compounds. Housing does not escape. Auto workers are homeowners. Suppliers are homeowners. Dealership employees are homeowners. In counties heavily exposed to auto manufacturing, home prices have already fallen between 11 and 18% within 12 months. Mortgage delinquencies climb. Foreclosures accelerate. Property tax bases erode. Municipal budgets crack. This is not a recession narrative. It is a balance sheet narrative. Equity markets respond brutally. Auto stocks and supplier equities have already lost hundreds of billions of dollars in market capitalization, dragging retirement accounts and pension portfolios down with them. Institutional investors reprice risk across the entire industrial sector. Capital retreats. And then the pressure reaches the currency layer. As trade flows weaken and foreign investors reassess exposure, confidence in United States assets erodes. Settlement in non-dollar currencies expands. Bilateral trade increasingly bypasses United States financial infrastructure. The dollar weakens, feeding imported inflation back into consumer prices. Households absorb the cost again. This is the point where policy mistakes become generational. What began as a tariff meant to force manufacturing inward now threatens to hollow out the financial scaffolding that supports entire states. And buried inside this unraveling is a vulnerability Canada understands very clearly, one tied not to factories, but to demand, credit, stability, and fiscal pressure. Because Canada's response is not aimed at production alone. It is aimed at the financial pressure points Washington cannot shield. By the time tariff pressure reaches factories, banks, and state budgets, global capital has already moved on. That is the part Washington consistently underestimates. Markets do not wait for speeches or elections. They respond to risk. And right now, United States policy volatility is being priced as a permanent condition. Across global manufacturing networks, the shift is already measurable. Open trade flow data and customs disclosures show that multinational firms have accelerated the redesign of supply chains away from tariff-exposed corridors. Over the past 12 months, automotive component shipments from Canada to European markets rose by nearly 30%. Shipments to East and Southeast Asia climbed by more than 1/3, driven by demand for low-emission aluminum, precision drivetrains, and advanced electronics modules. These are not spot transactions. They are long-term contracts structured deliberately to minimize exposure to United States trade policy. Capital followed the contracts. Investment commitments into Canadian advanced manufacturing zones now exceed $180 billion, according to aggregated project announcements and financing disclosures. Many of these projects are explicitly designed with non-United States export routes in mind. The strategic logic is simple. Stability now outweighs scale. Predictable access matters more than proximity. The contrast with the United States is stark. Internal surveys among global procurement and risk officers show that more than 70% of large multinational manufacturers have initiated or completed plans to reduce dependency on United States-based production or logistics nodes. Over the next 5 years, capital reallocation linked to this shift is estimated to exceed $900 billion. This is not paused investment waiting for policy clarity. It is redirected investment locked into facilities and labor markets elsewhere. Once those decisions are made, they do not reverse. Canada sits at the center of this transition, and for the first time in decades, it is not merely reacting, it is repositioning. Canadian policymakers increasingly frame market access not as a concession, but as leverage. Canada is not just a supplier to the United States. It is one of the most concentrated demand centers in the North American auto economy. That demand power has been underused. Canadian consumers purchase more United States-built vehicles than any other foreign market by a wide margin. Annual volumes exceed those sold to several major economies combined. That purchasing behavior has long functioned as a stabilizer for United States production lines, smoothing demand cycles and supporting employment across multiple states. Remove that stabilizer and volatility explodes. This is where the counterattack begins to take shape. Rather than mirror tariffs or issue public threats, Canada's response is quietly focused on demand redirection and procurement diversification. Government fleet purchasing policies, corporate procurement standards, and consumer incentive structures are being reassessed with a single objective in mind: reducing exposure to tariff-distorted supply chains. Even modest shifts have outsized effects. A reduction of Canadian purchases of United States-built vehicles by 1/4 removes several billion dollars in stable annual demand from American manufacturers. A deeper pullback compounds the pressure rapidly. This approach is difficult to headline. It does not arrive with press conferences or executive orders. But it is precisely why it is effective. Because demand-driven leverage operates silently. Every vehicle not purchased is not a protest. It is a balance sheet entry. Every diversified contract is not retaliation. It is risk management. And as these decisions accumulate, they feed directly into the same financial and fiscal pressure points already under strain inside the United States system. Washington can counter tariffs. It cannot easily counter lost trust. The most dangerous implication is this. Once Canada's diversification reaches a critical threshold, even a full reversal of tariffs would not restore previous demand patterns. Buyers who adapt do not revert out of goodwill. They remain diversified because it is rational. This is the moment where temporary policy mistakes harden into permanent structural change. At this stage, the tariff war has crossed a threshold most policymakers are unwilling to acknowledge. What is unfolding is no longer a dispute about trade balances or factory locations. It is a structural break in how the North American auto economy functions, and once this break hardens, it cannot simply be reversed by policy announcements. The most damaging consequence is not the immediate job losses or falling sales figures. It is the collapse of credibility. For decades, the United States benefited from an assumption that its market rules, once set, would remain broadly predictable. Companies accepted higher labor costs and thinner margins because the system was stable. That assumption has now been shattered. Tariffs are no longer treated by markets as temporary tools. They are treated as a governing doctrine. And once policy volatility is priced as permanent risk, capital behaves very differently. The evidence is already visible. United States vehicle production capacity now exceeds domestic demand by more than 25%. Plants operate below utilization. Inventories accumulate. Incentives balloon. Profit margins compress further. Excess capacity becomes a financial anchor, dragging down not only automakers, but suppliers, lenders, and state tax bases tied to those facilities. This is not a cyclical downturn. It is structural oversupply in a market losing export outlets. States feel the consequences long before Washington does. As revenues weaken and social costs rise, auto-dependent regions enter what fiscal analysts describe as a trap. Declining populations, shrinking tax bases, rising pension liabilities, and higher borrowing costs. Young workers leave. Skilled labor migrates. Municipal bonds reprice downward. These dynamics unfold over decades, not election cycles, and they are extraordinarily difficult to reverse once set in motion. Lowering tariffs now would not undo this damage. Factories that rerouted production will not return. Supply chains that diversified will not reconverge. Buyers who learn to reduce exposure will not voluntarily concentrate risk again. Even generous subsidies struggle to offset the uncertainty premium now attached to United States industrial policy. The system has already adapted, just not in Washington's favor. Canada understands this reality with increasing clarity. Rather than attempting to rescue a broken equilibrium, Canada's strategy centers on building a new one. Diversified export corridors, stable policy signals, controlled exposure to United States volatility, and most critically, deliberate use of its position as a demand center rather than a passive supplier. This is where the shift becomes irreversible. Canadian consumers and institutions quietly reshape purchasing behavior. United States-built vehicles lose market share year after year. Domestic and non-United States alternatives fill the gap. Tens of billions of dollars in once stable American export revenue fade permanently. Not through retaliation, but through adaptation. The impact is silent, cumulative, and devastatingly effective. The final irony is difficult to ignore. The tariff war was launched to force dependence on the United States. Instead, it accelerated independence from it. What was meant to pull manufacturing inward pushed capital, trust, and demand outward. Canada, long treated as an appendage of the United States market, emerges as a diversified node connected simultaneously to Europe, Asia, and the global South. This is not a temporary phase. It is a new baseline. For American workers, the consequences will linger long after political slogans fade. Lost skills do not regenerate quickly. Hollowed industrial towns do not rebound on command. Financial damage embedded in pensions, housing markets, and state budgets compounds quietly over time. And yet, there is one final element of this story that has not been fully examined. One decision path Canada could still take that would dramatically accelerate these pressures, push losses far beyond current projections, and leave Washington with almost no tools left to respond. That is the final shock. And in the concluding segment, I will explain exactly what that move is and why, once it begins, the North American auto economy will never look the same again. When the Oshawa shift was cut, the immediate focus fell on the workers who lost their jobs. That focus was justified, but incomplete. What the data now show is that this moment marks something far larger than a labor dispute or a trade disagreement. It marks a turning point in how economic power is exercised in North America. Tariffs were introduced with a clear promise: restore American manufacturing strength, reduce dependence on foreign supply, and protect domestic workers. Measured against outcomes rather than intentions, the results tell a different story. Vehicle prices rose sharply, demand weakened, production margins collapsed, credit stress increased, state budgets tightened, export markets eroded, and trust once lost did not return. Canada absorbed the first impact. The United States is absorbing the second. What makes this shift so consequential is not the scale of losses already recorded, but the permanence of the adjustments now underway. Supply chains that reconfigure do not revert. Buyers who diversify do not reconcentrate. Capital that reroutes does not wait for reassurance. It locks itself into new geographies, new contracts, and new political assumptions. Canada's response illustrates this reality with unsettling clarity. Rather than escalate publicly, it has reduced exposure quietly. Demand has become leverage. Procurement has become policy. Diversification has replaced dependence. Each step appears incremental. Together, they reshape the system. For the United States, the risk is not simply economic underperformance. It is strategic isolation by adaptation. Markets are not rejecting American industry out of hostility. They are pricing risk. And once risk is priced in, it becomes self-reinforcing. The lesson from Oshawa is not that tariffs failed Canada. It is that tariffs revealed how interconnected and how fragile the North American auto economy truly is. Power in that system does not belong solely to the producer or the policymaker. It belongs to the buyer who can walk away. Whether Washington recognizes that reality in time remains uncertain. Because if current trends continue, the most damaging consequences of this trade war will not arrive with headlines or announcements. They will arrive quietly, embedded in balance sheets, employment data, and consumer behavior long after the rhetoric has moved on. And by then, the outcome will already be decided. Is this a bold strategy to protect American industry, or a costly miscalculation that weakens North America as a whole? Thanks for watching.